Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Kevin Matris, Zach's Vice President and also Portfolio Manager of Zach's Options Trader. But I also have to bring this up because I know I did last time.
Okay.
Also the author of Finding Number One Stocks, Screening, Backtesting, and Time-Proven Strategies.
I love when you say that, Tracy.
I know, because not everybody's an author, so I always have to bring that up because that's kind of nice. It's
Thank
a
you
good
very
book.
much. Oh, I appreciate it.
Yeah, so people should check that out. But you're really here to talk about your portfolio and what it is you do manage here, which is the Zach's Option Trader, because I know I've always had all these questions about options. In full disclosure, I've never traded an option.
What?
I know.
Are you serious?
No.
You're just kidding, right?
I get asked this all the time on StockTwits, and they're like, do you have, a trade-in on this, or do you have a call on it, or whatever all those terms are? And I'm like, no, people, don't you know? I've
You're
never
just keeping
done
that
it.
a secret.
No, that's why I wanted you here, because I kind of wanted a trading 101, a beginner's class on options and how to trade them.
Okay.
So I know people have, a lot of questions, and they're just as clueless about it as I am. So what is an option? Why is that different than trading a normal stock?
Well, first off.
And why would I want to do it?
Yeah. Well, well, an option is really just another way to try and profit from the movement of a stock. So in the broadest sense, an option is essentially, it gives the investor the right to buy or sell 100 shares of an underlying stock at a certain price within a certain period of time. So there's really three key advantages or three main benefits to options trading that you would want to consider, and why it can be considered more attractive than actually getting into the stock itself. The three key benefits are leverage, flexibility, and with many strategies, you have a guaranteed limited risk. So the first one is leverage. You can get into an option for a fraction of the cost it would take to get the same number of shares of a stock. And that's important because if you don't have a lot of money, that is probably one of the easiest ways to be able to get yourself situated in a stock.
Yeah, these are that's the area where you always hear of these big success stories where someone will say I bought an option for $1,000 and I made $50,000 off of it.
Fantastic.
Yeah.
You don't hear that too often.
No, but occasionally people will brag about their big wins.
So big leverage. You also have a lot of flexibility as well, though. With options, you have the opportunity to make money if the stock goes up, if the stock goes down, and depending on your strategy, even if the stock goes sideways. So there's even some strategies, which we may touch on a little bit later today, but you can actually be wrong on the direction of the stock and actually still make money. So that is a very, very attractive proposition. And the other thing is limited risk, right? A lot of option strategies have a guaranteed limited risk, meaning you cannot ever lose more than what you put in.
Okay, you were talking about how with the leverage side, you need less than if you actually went out and bought 100 shares of, say, Amazon or something. How little can you spend to do an option? Is there a limit?
Well, I mean, you can buy options that are way out of the money for literally, pennies for premium, which would be a couple of dollars. But those have such a low probability of success, you would never want to do that. So there are some guidelines which we will touch on. Okay. But you can still get good quality options if you're going to be spending anywhere from, $300, $500, $600. You can get a good option, and you can have a very reasonable chance of standing to profit if, in fact, the stock goes in the direction you were hoping it was going to go into.
Okay, one other thing with options that I always felt was an issue was it's kind of seems to me all or nothing, even though you say it's reduced risk. But if I spend $500 to get those options, I may lose all $500.
Yeah, that is something that you have to consider. So, when you buy an option, your maximum risk is what you paid for that option. So if, let's say, for example, you bought a stock and the stock was at $50, and let's say 3 months later, that stock was still at $50, you haven't gained or lost anything. You have virtually unlimited staying power, right? With an option, though, you have a limited amount of time you can stay in that vehicle. So if, let's say the stock was at $50 and I bought, let's say, a $50 call option. And 3 months later, that stock was still trading at $50. That option would now expire worthless. There is no intrinsic value, there is no time value left, and my option would now be worth zero, which means I lost the entire $500 that I put up. So it's very, very important, if you're going to be buying an option, that you have a semblance as to, what your time horizon is. If you're expecting the stock to make a move, you need to kind of ask yourself, okay, I'm expecting this stock to make a move. How big of a move am I expecting it to make? And over what time period am I expecting this move to take place? Because if, let's say, you're expecting something to take place over, let's say you have a long-term horizon, a 12-month time horizon, and you buy a 2-month option, well, if nothing happens within that 2 months, you've just lost everything. So you have to be very, very cognizant of your timing when you're buying a call and a put.
Okay.
By the way, let me just touch on the definition of a call.
Yeah, good.
Because
we keep saying those words.
Every single strategy that you use, whether it be a basic purchase of a call or a put, or a sophisticated strategy like an iron condor, which is my favorite, or calendar spreads, or this kind of thing, it all revolves around these two vehicles. So a call option, basically, these are the two most common ways to do anything. But if you believe the price of a stock will go up, you buy a call option on it and make money as it goes higher. If you believe the price of a stock will go down, you buy a put option on it and make money as it goes lower.
Can I buy a call or a put on any stock?
You can buy a call and a put on virtually any stock. Obviously, the
stock... There might be the penny stocks you couldn't or
yeah,
something
so
like that.
When you're looking at a screener or if you're looking at some kind of financial page, you'll see if that stock is optionable. Some stocks don't have options on it, but as long as the stock is optionable, you can do that.
Okay. And I just buy those through my normal broker.
Buy it through your normal broker. I mean, the commissions are very cheap. It isn't like 20 years ago where you're paying a fortune. Interestingly enough, though, you can also buy a call and a put simultaneously. And that strategy, I don't want to get ahead of myself, but those strategies would be called straddles or strangles.
Sounds complicated.
Yeah. Well, you would use a strategy like that, and it's really ideal to do in front of earnings season because, it's not uncommon in earnings season if a stock positively surprises or negatively surprises to see a stock shoot up 10, 20% or collapse 10 or 20%. If you were to buy, or if you thought that there was going to be a big move because of this earnings announcement, but you didn't really know which way it was going to go, you could buy a straddle or a strangle, simultaneously buying a call or a put. And if the market does positively surprise and you see a spectacular rally, the amount of money you would make on the call option would more than offset the loss on your put, and you would profit that way. If, in fact, the stock just collapsed, even if you thought the market was going to go up but weren't really sure, and the stock just dropped like a rock, the amount of money you would make on a put option would significantly compensate for the limited amount of money you lost on the call, and you can profit that way as well. As a matter of fact, even if you were in a stock and you were worried that the stock was going to negatively surprise, you can buy a put option against it to hedge your risk. Just in case the stock went down, you could make a little bit of money on the put option to offset some of the loss on your stock. So there's a lot of really cool things you can do.
Okay, so for beginning investors in options, is it easier to do the call or the put? Like if I should just focus on one, which one should I be focusing on?
It's just as easy to buy a call option as it is to buy a put option. And the math works out the exact same way, right? If it goes up X percent, you're going to make X amount of dollars. If it goes down X percent, you're going to make X amount of dollars based on whether you bought a call or put.
But should I start with one? Like, is it better for me to, root for them to go higher and start with the call?
I would say since the overwhelming majority of investors have a bullish bias, I would focus in on what you're most comfortable with, which is rooting for the upside. So yeah, I would probably tell people to start off with buying call options so they can get a feel for, how it works. It'd be weird if, let's say, you're always buying stocks and then you buy a put option. You may not know how to digest what's happening when the market goes down and you're actually making money. It would be a weird disconnect. So I would probably focus on buying calls if you typically buy stocks.
How do I choose what kind of company to buy my option on?
It's interesting. I would say first off, if you are a user of the Zacks rank, right, you will buy a stock if it has a Zacks rank of a 1 or a 2, or if it has a style score of an A or a B. So I would go about looking for my options investment in the same way I would start off by trying to find a stock investment. So I would do my research on a stock. I would find a stock that I believe has a high probability of success. And then once I have this actionable watch list of companies that I really, really am interested in, that I think are going to do a certain thing, in this example, going up, then once I have that watch list, I would start looking at the options chains, and I would try to find the options that have a decent amount of open interest, a decent amount of volume, and I would also want to make sure that the bid-ask spreads were tight enough, close enough, where I believe that I won't have to give up a lot of premium to get myself in. You can get into options where the bid-ask spread is hundreds of dollars wide, which means you're giving up $100 or so on the way in, you're giving up $100 or so on the way out, which means you need to see a significant move one way or the other just to be able to cover your entry and exit slippage. But if you're finding stocks that have very, very tight bid-ask spreads, like the Facebooks of the world, or the Microsofts, or the Teslas, or whatever, the stocks that have very high volume and open interest, normally you're going to be able to find very, very tight bid-ask spreads, and then you'll be able to make a determination, hey, is this an option that I want to do? But the takeaway is, I would always look for the fundamental underpinnings of the stock. Once I found a stock, I will then look at the options to see if there is an advantageous strategy.
Okay. You talked a little bit earlier about the earnings and, buying if you expect it to have a big jump on the earnings. Do most people play the options around earnings? Does that make the most sense?
I play options all the time, but I think, using options in front of earnings is a great idea because, there's a lot of people who are afraid to hold on to a stock in front of an earnings report. If let's just say that you're in a $100 stock and you have 100 shares and something happens and it drops 20%, you've just lost $2,000 on that stock option, on that stock investment. But if let's just say you were thinking, hey, I think this stock is going to go up, but it may not, but I think it's going to go up. So you decide to buy a $400 option, $500 option that's right at the money, right in front of earnings. The stock just falls through the floor. while you may have lost $2,000 on that stock investment, you literally only lost $400 or $500 on the option. And if there's still time left, you haven't even lost everything. You've only lost a portion of it. So a $2,000 loss on the stock may only result in a couple of $100 loss on the option, even though the stock collapsed. You've just saved yourself a lot of heartache, and you've limited your risk considerably by doing it that way.
Let's talk about some examples now, because I know you brought me a couple to go through kind of step by step and lead us down the path for those of us who don't know what we're doing. And the first one you wanted to talk about is Johnson & Johnson, kind of the old company there.
Yeah, I like Johnson & Johnson. I am in it. They are a Zacks rank of a number 2. Their industry is ranked in the top 18% of Zacks ranked industries. So first off, that covers what we just said earlier about making sure the fundamentals are in alignment for seeing that stock do a certain thing, in this case, go up, right?
So you have a call on it.
Yeah, have a call on it. But for this example, so first off, right now, Johnson & Johnson's trading at about $114, something like that. That's what it looked like when we got in here. And but I have a near-term price target on Johnson & Johnson of $125, and I think that it's going to hit $125 over the course of the next few months. So if you're bullish on it, as I am, you can get into Johnson & Johnson in many different ways. But for today's discussion, we're going to be buying a call, and I want to show you the comparison between getting into the stock and getting into the option, okay? So, again, I believe that the near-term price objective is $125, and that would represent almost a 10% increase in price if it did that. If I wanted to buy 100 shares of Johnson & Johnson, that would require an investment of $11,400, right? 100 shares times 114, 11,400. If the stock moved to $125, that would be an $11 move, which means I would make $1,100 on that stock investment. That would be a 9.6% gain. Fantastic, right? However, though, if I was to do an option, I can currently get an October 110 call. That's an in-the-money option. And right now, I could pay about $610 or $610 for that option. That is going to give me the right to buy Johnson & Johnson at $110 within the next 5.5 months. The October option has about 5.5 months worth of time.
Okay, one thing. What does in the money mean?
In the money is simply it's the amount of money that the option price is below the or the amount of the strike price below the current price. So in other words, if let's just say Johnson & Johnson was at 115, and let's say I had a 110 call option. That option would be $5 in the money because it's currently that stock price is $5 below the current price of the stock.
Okay, so if you had the call option at 117 in that example, you would not be in the money.
Right, that would be an out of the money option. So if let's say the price of, for easy math for right now, let's say Johnson & Johnson was at 115. A 115 option would be at the money, right? It's at the current price. Anything below 115 would be an in-the-money option, and everything above the 115 would be out of the money. Okay. So in this example, with Johnson & Johnson at, let's say, 114, and we're buying the 110 call, we are buying an in-the-money option. Okay?
Right.
But anyways, so at expiration, if Johnson & Johnson was at $125, that option would now be worth $1,500. Because again, don't forget, an option gives you the right, but not the obligation, to buy 100 shares of the stock. If the stock is at 125 and we had a 115 call option, that would be, or excuse me, 110 call option, that would be $15 or $1,500, right?
Okay. Mm-hmm.
So it's worth $1,500, but remember, if I bought the option for $610 and it's now worth $1,500, that means my gain would be $890. Do you follow me?
Yes.
$1,500 less my cost of $610 equals an $890 profit. That would be equivalent to a 146% gain. Now, I could actually pick up two of these options for as little as $1,220, right? 610 times 2, I'm spending $1,220. So that would now increase my profit potential to $1,780. So if I thought Johnson & Johnson was going to go up to $125, that would only be about a 9.5% gain or 9.5% increase in the stock. But here, I could literally put up 1/10 the amount of money, and I would literally be able to make 1.6 times the return. The stock, I have to put up $11,400. Here I've put up $1,200. The stock, I've made $1,100. With the option, I've made $1,780. Tremendous amount of leverage, lots of flexibility, and for a very small amount of money, you can make even more than you can if you actually bought the stock. Now, another way to look at it, though, is this. So here we're talking about the idea that somebody's going to be buying 100 shares of a stock, right? That may be a tall order for some people. Think about it this way. If, let's say, we were talking about buying an option for $610, right? Once again, an option gives you the right but not the obligation to control 100 shares of the underlying stock. For $610, we're basically controlling 100 shares. If I were to, let's say, buy the stock, I would only be able to get 5 shares of that stock for $610. So if Johnson & Johnson went to $125 and I literally only had 5 shares of that stock, that would be a $55 gain.
Right.
But if I put $610 into the option and it went to $125, I've just made $890.
Right.
So you tell me, what would you rather do? Would you rather put $610 into the stock and make a whopping $55 before commissions? Or would you rather put $610 into the option and make $890?
Right. Well, the leverage really shows up.
Correct.
You can see the big difference.
But again, as long as you are smart about not putting too much money into an option, right? I mean, some people, they think, oh, I got all this fantastic leverage, I'll go put in a ton of money. Don't put in a ton of money. I would say the rule of thumb is if, let's say, you're used to spending X amount of dollars on a stock, let's say $10,000 on a stock, and let's say you're willing to risk 10% on a stock investment, right? So if I say I'm willing to risk $1,000 on a stock being wrong, if my maximum threshold, or at least, what I'm trying to limit my risk to in a stock is $1,000, I would never put more than $1,000 in the option, knowing that if the proverbial stuff hit the fan, I would lose $1,000. So however much money that I am willing to lose in a stock trade, I will limit that investment to what I will put into an option. And if you can keep that as a rule of thumb, you can make sure you never blow up an account.
Okay. Well, what happens if Johnson & Johnson doesn't go to the 125 then? That's when it blows up, right?
Yeah. Now, if Johnson & Johnson we're buying a 110 call, so I need Johnson & Johnson to be trading at least above 110 to be able to make something. So if, let's say, it closed at 114, which is where it was when I bought it. Don't forget, my option is $4 in the money. Right. So at expiration, if that call out, if Johnson & Johnson was still trading at 114, it's no longer going to be worth $610. That option will only be worth $400. Why 400? Because my option is 110. The current price of the stock is 114. And that means the difference at expiration is my intrinsic value, the difference between the current stock price and what my strike price is. So I'm going to lose about $190 on that trade.
Yeah.
Or $210 on the trade.
Yeah.
But I still got something. I didn't lose all of it.
Right.
I only lost a little bit of it.
Okay, that's a good way to look, at it, and good explanation
Right.
of how that works.
The other thing I would say too is, there's something called time decay. Options usually move relatively slowly as far as, the options wasting away. They call it a wasting asset because there's only a certain amount of time you can hold on to it. But the phenomenon of time decay usually takes place rapidly within the last 30 days. So if you bought, let's say, a 6-month option and nothing's really happening, once 5 months of time has elapsed and you're in that 30-day red zone, I would definitely tell you to get out of that option with only 30 days left and go out and buy a little bit more time, because now you'll be able to hold on to that trade for a little bit longer. It's funny, too, because most people, I would say the reason why most people lose is because they're a little bit too aggressive in expecting their stock to do something within a certain amount of time. If you believe that the stock is going to go up to X within 3 months, go buy yourself more time. Buy a 4-month option, a 5-month option, a 6-month option, because oftentimes the difference between somebody making money and losing money can come down to a matter of days or weeks or a month. So you may think at the outset, I don't need that extra month of time. More often than not, that extra little bit of time will do you good, and it could be the difference between making money and losing money. And also, I would say, buying the option with more time is actually the better value. Because if, let's just say that you bought, let's say you had 2 options. Let's say you had an option with 6 weeks of time, and let's say you had an option with 12 weeks of time. If I paid, let's say, $600 for an option with 6 weeks of time, and I had another option where I paid $900 for 12 weeks of time, let's do this math real quick. If I divide $600 by 6 weeks, I'm effectively paying $100 for each week of time that I purchased. If I were to divide $900 by 12 weeks of time, I've got twice as much time. I didn't pay twice as much as the option, just a little bit more, which is what you'll see when you look at an options board. Here, $900 divided by 12 weeks, I'm only paying $75 per week. So you're paying less for each unit of time that you've purchased, which will make it the better bargain. And that extra amount of time that you've purchased, like I said earlier, can oftentimes be the difference between having that little extra bit of staying power to hang on to that trade for a little bit longer.
Okay, you brought another example, too, with Simon Property Group. That ticker is SPG.
Yeah, same thing. We'll walk through basically the same kind of example. It's a great stock. They're a Zacks rank of a number 3, but their industry is in the top 38% of Zacks ranked industries. I personally like it because I happen to really like the real estate space and I like the retail space. And these guys are big on malls and strip malls and this kind of thing. But this stock is trading at $212. So if you have a small amount of money, you're not going to be able to get a lot of shares. I mean, for the first example, right, $610, I can get 5 shares. You'd be lucky if you can get like 2-3 shares of Simon Property Group for a very small amount of money.
Right.
But for this one, it's $212. I'm expecting a price target of $240. So we're going to do the same kind of math. If I bought 100 shares of this stock, that is going to require an investment of $21,200. That is a sizable investment for a lot of people.
Yeah.
If it went to $240, that would be a $28 move, and you would make $2,800 on the investment. Fantastic. That's a 13.2% gain. But you could get into SPG through the options for a much smaller investment. You could buy an October $210 call for $1,035. Once again, this option is in the money. And like the other example, it has 5.5 months of time on it. So at expiration, if SPG was at $240, which is what I'm expecting to see this happen over the course of the next maybe 3 to 4 months. I've got a 5.5 month option. If that happened, this option would be worth $3,000. So if I bought the option for $1,035 and it's now worth $3,000, that would be a profit of $1,965. Follow me?
Yeah.
And that represents a gain of 190%. And again, if I bought 2 of these options, that's still only going to require a $2,000 investment, actually $2,070. But again, my profit would be almost $4,000. And if you make the comparison, you're talking about investing roughly 1/10 the amount of money in an option that you would have to invest in the stock if you wanted to control 100 shares, but you're getting 1.4 times the return. So again, it's another great example of leverage. And once again, if the stock collapsed, for whatever reason, the stock goes down 10%, 20%, you could lose a lot of money. You could lose $2,000, $4,000, $6,000. But you're literally limited to what you paid for the option, which means if some catastrophic thing happened to SPG, you're limited with one option to $1,035, or if you get out, as long as there's time, you're only losing a portion of the 135. And in order to lose everything, you would have to stay in that option. The stock would have to continue to not go in your favor, and you'd have to hang on until the bitter end. If you have a little bit of discipline and realize, the probabilities of success have changed, I'm going to get out, you'll always be able to get at least a little bit for your option. So that's another reason why I believe options are a great way to go.
Okay. Another example you had is a name we all know, which is Facebook.
All right, so
FB.
So for this one, I wanted to give an explanation of a bull call spread.
Uh-oh.
So
sounds more complicated.
Pay attention, but it's a fantastic way to do options. So as you know, Facebook, they just reported earnings the other week. They crushed it. Not surprisingly, they're a Zacks rank of number 1. Fantastic. So a bull call spread is also known as a debit spread. This involves buying a closer strike and then writing a further away strike. It's not a fancy strategy. It's not even that sophisticated. It's probably after buying calls and buying puts, bull call spreads are probably the next common type of strategy people use. I should also say, too, that a bull call spread, it's a bullish strategy, but it's not for runaway bull markets, right? If you think the stock is going to just blast off to infinity, you wouldn't want to use a bull call spread, because one of the caveats with the bull call spread, you do have a limited risk, but you have a limited profit potential. So there's only a certain amount of money you can make, but there's lots of advantages that makes this a very, very popular strategy. But anyway, so let's go through the example. If I wanted to get into a bull call spread, let's look at the December 115, 130 bull call spread. I could buy the December 115 call for $1,370, and I could write, another way of saying write is I could sell it to open, a December 130 call for $660. So I'm paying or being debited $1,370, but I'm being credited with $660 for writing that option. So it's a net debit of $710. In other words, it's costing $710 to put this bull call spread on. That's the max cost. The spread will be $710. And by the way, even if Facebook went to 0, I could never lose more than $710. Okay, but we have a $15 wide spread on. If Facebook goes to 130, that's not a huge move from where we are right now, but I do think over the very near term we'll see 130. This strategy will gain $790. That's a 111% return. So I'm paying $710 for this bull call spread, and I believe that I will actually profit. I'll make an additional $790. And the reason why that's true is this. At expiration, the 115 call would be worth $1,500, but we paid $1,370, so we're only making $130 on that long call. Okay. However, the 130 call that we wrote, the guy who bought it it would be worth zero for him. That option is worthless because it's at the money. There's no intrinsic value. So the person who bought that 130 call makes nothing, but we sold it to him. We're the writer. We collected all of that money. So that $660 would be complete and straight up profit for us. So we made 130 on the long call. We also made $660 on the short call, which means we made a total of $790 on the entire trade. So it's a great strategy. The reason why somebody would want to use a bull call spread is because sometimes options can be they can be kind of expensive. Think about it. We ended up buying the 115 call in Facebook. The stock went all the way up to 130, but that one call itself literally would have translated to only a $130 profit. So if I did not have that other side, which was benefiting from that time decay, I don't want to get too complex here, but if I only had the long call, I would have only made $130, but because I had that short call, which was benefiting from the time decay, I significantly enhanced my return because I made an additional $660. So I went from a $130 profit to a $790 profit. Either way, let me back up and say, bull call spreads are easy, but start with just straight up calls and puts. Start with straight up calls and puts, but they're very easy to master as long as you use some common sense.
How do you know when certain options are expensive? You just said that this one for Facebook was expensive. Is that just because more people are playing it?
You know, a lot of times it has to do with volatility. When volatility is high, option prices will be more expensive, but there are just some innate things that make certain options trade at relatively high prices. So you just have to kind of get a feel for it.
Okay.
But, when I would say for starting off, as we were saying before, make sure that you understand the fundamentals surrounding the actual stock itself and just decide how much money you're willing to spend on an option. For, if you're talking about a stock that's let's say anywhere from $70, $80, $90, $100, you can get a pretty good option that's right at the money, anywhere from $300 to $600. And I think if you stay within that area, you probably should be fine. And also, too, you won't be panicky because if you were to just spend, right, if let's say you're looking at a Google option or something else and you're spending, $6,000 or $8,000, there's options out there where you can spend $10,000, $15,000, $20,000 on an option. The slightest move is going to make you panic.
Yeah.
So keep your original outlay relatively small. Give yourself a fighting chance by not buying options that are too out of the money. Stick with something that's at the money or maybe one strike in. Keep your outlay relatively reasonable and just pay attention to the stock. If the stock isn't doing anything, just know that every single day, a tiny little amount of value is going to be taken out of that option because your time value is wasting away. It forces you to be diligent. Actually, trading options makes you a better stock trader because you can get complacent with a stock. With an option, you don't have to, but you want to watch it. You want to see, is the stock just going sideways? Is there a better place I could put my money? If, let's say, you just are not as enamored with this idea as you were in the first place, take that money out and then go put your money onto another bet, something that you believe has a higher probability of success. But you owe it to yourself to be able to look at options. It's too good of a vehicle to not do it. And you don't have to wait for a bull market, right? Everybody right now, the market's going straight up. So it's like, oh, I love stocks. Everything is fantastic. But when the market goes sideways or when the market goes down, people think, well, I'll never be able to make any money in stocks. With options, there are so many ways to make money, and you will feel liberated, and you'll feel like the smartest person in the room when you're actually making money while the market's going down or going sideways when nobody else is able to.
Okay, so in your service, the Zacks Options Trader, you do both the puts and the calls in there, right?
Do both puts, calls. We also do writing strategies.
Okay.
We do the spreads.
You do the more advanced iron condors.
The condors, which I love doing, or the calendar. There's a lot of cool stuff, and we walk people through it. You don't have to be a sophisticated options trader to benefit, because we walk you through every single trade. And let me tell you, you do one or a couple of trades on your own. Once you feel what it feels like to buy an option, see how the option moves in relation to the underlying strike price. Once you do a couple, you'll feel like you're a pro at it in no time. And you will feel like you've discovered some great secret. Because the pros use it.
Some people love it.
Pros use it, and they make a fortune. Regular investors, if they just, took a look at it, they would realize, wow, I didn't realize that you could make money this way. And, you'll feel good about it.
How many positions do you have in options trader?
I usually will probably have anywhere from like maybe 10 to 12 positions, sometimes
That's
more, sometimes less. I don't want to get into it too sophisticated of a topic, but I like to look at my net aggregate delta.
That sounds confusing.
Yeah, we'll talk about that at a later time.
Second podcast.
But yes, we'll usually do right around 10 positions, and we just want to make sure that we are well diversified. I usually like to be able to put bets on that can participate in all three of those directions, which is up, down, or sideways.
Okay,
that is a nice, well-rounded portfolio.
Okay, well, this is really helpful. Because I know I learned a lot.
Are you going to trade options, Tracy?
I don't know. I might now. I might try to jump in. We'll see.
I will walk over to your office, and I am going to walk you through a trade personally.
Okay, wow. I get my own coach.
Right, it's going to cost you, though.
Oh, probably, yeah. I'll have to think about it then. But if you want to know more about what Kevin's doing, he does run the Zacks Options Trader. You can find that on Zacks.com. Check that out. He also has, you write options articles too on the site?
Know Your Options articles.
Yeah, so you can check out those. Those are free on the site.
Right.
Click on those. Are there videos?
There's videos, but also, too, you mentioned at the top of the show that book, Finding Number One Stocks. I have an options section in that book as well, so you may want to check that out. You can get a great education that way also.
Okay, yeah, I'll have to check that out because, I listened to everything you said, but I might need a refresher.
It's funny, too, when you're doing the options and you're walking through the math, it's easy to say, but sometimes then seeing it on a piece of paper as well, it brings it all together. You'll realize it's very easy. It makes perfect sense.
Yeah.
But when you're talking a bunch of numbers, having something in front of you changes everything.
Right.
Yeah,
I agree. Okay, so you can check all that out on Zacks.com. Be sure to do that. And you can also see our other podcasts. We had an excellent podcast a couple weeks ago that was on how to screen for stocks.
Oh, yeah.
Definitely check out that, too, because there's a lot of good advice in that one.
We also had that podcast
on
many months ago about movies.
Yeah,
and
movie
it's funny,
stocks.
Right before we started talking about this, we started talking about Captain America. Before we went live, but let me just say Captain America was phenomenal, and we need to do a follow-up on that movie podcast.
We should.
Yeah.
Well, Disney's reporting soon. I think we had Lionsgate.
Good.
We'll do the movie stocks again because it is an interesting topic over the summer movie time.
Yes.
Okay. But definitely be sure to check out all those podcasts are on iTunes. You can also get them on SoundCloud.com. We're on Android as well on Google Play. So be sure to find us over there. Until next week.